Hi, in this video I'm going to look at city analysts. Now you may have read about them in the press but not be quite sure exactly what they do. So I'm going to look at what their role is and whether they actually matter to the likes of you and me, to private investors. So there's two main types of analyst. You have the buy-side analyst and the sell-side analyst. So we'll start with the buy-side analysts. The buy-side analysts work for the big investors, for the fund management companies, for the pension funds, for the hedge funds. And they spend their time analysing and evaluating companies. They'll look at the financial information. They'll look at how profitable a company is, how much debt it has, how much cash it generates. And the analysts will also look at the prospects for that business. And they'll then give an investment recommendation to the fund manager, and the fund manager can decide whether to buy shares in that company for the fund. And so that's why buy-side analysts have that name, because they're analysing for the buying process. They work for people who are buying shares, the big investors, the fund managers. Now, in some ways, the sell-side analysts are very similar to the buy-side analysts. Just like the buy-side guys, they spend their time looking at all the financial information that a particular company produces, all the profits, the debt, the cash, etc. And they also look at the future prospects for any particular business. And they don't just look at individual companies, they also look at sectors. So you might have a sell-side analyst covering the UK retail sector or the European construction sector. And these sell-side analysts, they normally work for the big investment banks in the city or for the stockbrokers. And they're called sell-side analysts because they're effectively selling shares to the big fund managers, to the big investors. So let's just look in a bit more detail about some of the work that the sell-side analysts do. There's four main components of the output, if you like, the four main components of the things they actually produce. So first off, you have the ratings. So this is, the classic stuff that you'll read about in the press. Buy, sell, and you'll always hold and reduce and accumulate. All these different ratings that you might read about in the press. So that's a big part of the sell-side analyst's role. And then the analysts, they also write notes and reports. So they might write a note, a fairly short note on an individual company, or they might do a longer report, perhaps on a company or on a sector, like the UK retail sector that I mentioned. So they'll then look at the prospects for UK retailers across the board and also identify the most attractive retailers as potential investments. Then three, sort of the third output, if you like, that the analysts do is what I call IPO support. So when a new company lists on the stock market, say Facebook in the US, that happened last year, you'll get lots of analysts talking about the prospects for that company, Facebook, both in terms of reports, but also talking to fund managers, potential investors, and the press. And often the analysts will be employed by investment banks who are helping Facebook with their IPO. And then the fourth thing that the sell-side analysts do is they produce forecasts. So if you were thinking about buying shares in, let's say, Tesco, you'd obviously look at how much profit they made last year and the year before and a few years before that. But it's also good to know how much profit Tesco is going to make this year and next year. An analyst's forecast can give you a figure as to what Tesco's profits might be over the next 1, 2, or 3 years. So that's another useful thing that the sell-side analysts produce. So that's all very well. The problem is you can't necessarily believe all the things that the analysts put out. In other words, their credibility isn't 100%. And there's two real reasons for that. And it all really links back to how sell-side analysts are employed and how they're paid. So I said earlier, the sell-side analysts, they're employed by the big investment banks, by the stockbrokers. So let's have an imaginary bank. We'll call it J.W. Goldman. And let's also have an imaginary retailer. We'll call it Tesbury's. Now, J.W. Goldman might have a close relationship with Tesbury's. Actually, last year, Tesbury's bought a Spanish supermarket chain. And J.W. Goldman, as an investment bank, helped Tesbury's make that purchase. They helped them get through the whole takeover process. They were a financial advisor. And doing that work was very lucrative for J.W. Goldman. So they don't want to fall out with Tesbury's. They want to be involved in any future deals that Tesbury's may do. Or if Tesbury's decides to issue some new shares to raise some cash for investment, or Tesbury's might issue some new bonds to raise cash. Every time, J.W. Goldman wants to be involved. So they don't want their analysts to be too critical of Tesbury's. And that applies regardless of whether J.W. Goldman is currently an advisor to the retailer. Because even if a bank isn't an advisor right now, they're hoping to be an advisor in the future. And that's why there's this huge question mark against the impartiality of sell-side analysts. And as a result, you really can't take the buy, sell, hold ratings too seriously, especially the buy ratings, because there's way more buy ratings out there than sell ratings. And I think with notes and reports, I mean, as a journalist, I've read many notes and reports over the years. And they can be useful. They can help you understand the business model of a company in more detail. And that's because the analysts get lots of access to the company directors, so they understand how the company works. But equally, I've read loads of reports that have been proven completely wrong by events. And I think that's at least partly because of this impartiality issue, but also partly actually sometimes because the analysts just aren't that good. Now, you as a private investor, it's highly unlikely you'll be able to get hold of any of these notes and reports, but just don't worry about it. Doesn't matter, not important. In many ways, you're better off without them. And then with the IPO support, again, you probably won't see the big notes that analysts put out when a new company lists. Again, I really wouldn't worry about it, just not that important. Then there's the forecasts. Now, I actually think the forecasts are more useful and do have more credibility than the other things we've looked at. They're not perfect, they're not gospel truth, but they have more credibility. And I think the important point, Tesbury's, a big retailer, might have as many as 20 analysts following it, and they'll all give their own individual forecasts for profitability over the next 2 or 3 years. And what you can do is you can average out those forecasts and you get the consensus forecast figure. And that consensus forecast figure is useful, it's reasonably reliable, and it's also being widely used across the city. So you as a private investor, when you start your investment process, you know what figures the rest of the city are using. And they can be at least fairly reliable, not gospel, but fairly reliable. So the consensus forecast, I think, does have some value. And the good news is it's really very easy for private investors to get hold of these consensus forecasts. You can find them on websites such as ft.com, Yahoo Finance, and several others. You just go and look at the financial reports, the financial information, and you won't have to look very hard to find consensus forecasts for profits for next year. So that's a really useful thing, and as I say, they're worth following. I think the other thing you need to bear in mind when you think about what the analysts are doing, the sell-side analysts are doing, is not only are they under pressure to help the big banks get financial advice work, also the big banks will do the buying and the selling for the investment funds, for the pension funds. And every time they buy and sell a share for a pension fund, they get a bit of cut, they get a bit of commission. So the banks and the stockbrokers like to encourage the investors to buy and sell shares as much as possible. And the analysts are part of that process of encouraging investors to buy and sell. And really, that's a very dumb idea. You don't want to overtrade as an investor. So that's another reason, I think, why there's a question mark over really a lot of what the sell-side analysts do. Just as a final point, so far we've only been looking at analysts who cover equities, who cover stocks and shares. There are also analysts out there who cover debt, who cover government debt, and also debt by individual companies. Some of these analysts work for the rating agencies such as Moody's and S&P. I think the financial crisis really dealt a massive blow to the credibility of those credit analysts, so don't pay much attention to them. And as a private investor, they're not really that useful, they're not that important. You're more likely to be focusing on stocks and shares, on equities. And when you're looking at equities, the most important analyst is you. Do your own analysis, believe in your own analysis, and if you do that and stick to your guns, I think there's a good chance that actually you'll perform pretty well.